Hi everyone, like I said in previous videos, October is a month to watch the market closely, but not to make a lot of movement. It's getting pretty down. So today I'm talking about how a company like Netflix manipulates its financial statement to achieve its goals. How will this affect us investors? Is the stock overvalued or undervalued? If you want those answers, but don't want to take an accounting course or read hundreds of pages of report, then the next 10 minutes is very important to you. If anytime you find the video helpful, please click the like button, subscribe, and turn on the little bell notice. There are two kinds of financial statement manipulation. One is to exaggerate the profit, earnings, to attract more investors. The company best at this is definitely Netflix. The other type of manipulation is doing the opposite. Hide the profit, earnings, to keep a low profiles. The typical representative is Microsoft. If enough people are interested, we'll discuss that in the future video. First, let's clarify. Financial statement manipulation is completely different from statement fraud. Manipulation occurs in almost every company's statement. Think about your resume. You can use all the big and nice words to decorate your background and experience, but you can't just make something up. It will get you into trouble. Okay, getting back to Netflix. There's a model called Banish Model. I wouldn't get into details of this model since it takes time and more financial knowledge to understand. This model is a mathematical model to identify how much a company has manipulated its earnings. It is used as a tool to uncover financial fraud. The higher the score, the more manipulation going on, and of course, one step closer to fraud. For the last 3 years, the score for Netflix has been significantly higher than the dangerous line. Wondering at that line between manipulation and fraud, but successfully maintains a good balance. How did it achieve this? Here is a useful trick for people without much financial background. The easiest way to learn how much a company manipulated the financial statement is to compare the following indicators. Net income versus operating cash flow. Let's use an old-time example. In the 70s, your parents or grandparents run a small restaurant. Net income equals sales minus product cost minus other costs, such as rent, utility, labor, etc. This should equals to operating cash flow. If they let you read the accounting book at the end of the year, this is a zero manipulation book. However, as accountants received better and better education, they made this simple process more and more sophisticated. Although the original purpose was to make the financial statements more accurate. For instance, modern bookkeeping involves a lot of non-cash income and expense. A typical example is assets appreciation or depreciation. There is usually no objective standard for these. Financial guys make their own judgment. Therefore, there is plenty of room to perform manipulation. If they want to show better financial status, all they have to do is to increase non-cash income or decrease non-cash expense. Thus, the net income will go up. Now you see what they can do. But what you can do to see through the accountant's tricks? Cash flow. That's something they cannot manipulate. Playing with that will get them over the fine line and it will become fraud. Comparing the net income that can be manipulated to the operating cash flow that cannot be manipulated is a straightforward way of judging how much manipulation a company made. We've learned from the restaurant example. If net income almost equals the operating cash flow, then there's almost no manipulation. If net income is more than operating cash flow, this means they're exaggerating their net income. There's definitely bubble in the net income. The income quality is low. If the net income is less than the operating cash flow, it means the income quality is high. In a reliable statement, these two parameters should increase together or decrease together. If operating cash flow increases, the net income increases. However, if the operating cash flow decreases but net income increases, this would make me question the quality and the reliability of the income. We can take a look at the other 4 companies in FANG. For example, they're all good companies. Right? Let's take a look at the last 10 years net income versus operating cash flow. Horizontal axis are years, while vertical axis are income or operating cash flow numbers. The unit of Facebook is million, while the others are in billion. The orange line stands for operating cash flow, while the blue line is net income. All of these companies' operating cash flow is higher than their net income, and they share the same trend. One increases, the other increases. One decreases, the other one decreases. The stock price also shares the same trend for all of them, moving up most of the time. No wonder they are top companies in the market, and the financial statement is high quality. Wow, who do you think this is? Yes, it's the star of the day, Netflix. They say one picture equals 1,000 words. I'll let you stare at it closely for a few seconds. Starting from 2014, the operating cash flow was negative for 5 consecutive years. No matter how popular they get, they're missing a profit. The trend is getting worse. Maybe this year it can slow down. The net income has always been higher than the operating cash flow. Based on what we just mentioned, their net income quality and reliability is low. Too much bubble. It is very rare to see the operating cash flow and the net income goes farther and farther apart. This is a rare scene for a big company like this. I'm pretty sure the other 4 I just showed have manipulated their financial statement more or less. However, I have never seen manipulation like Netflix. How did they achieve this under the radar? When mentioning the income and cost for Netflix, what's your first impression? Major income for Netflix is the subscription fee. Major cost is to produce movies or TV shows or purchase their copyright. Wrong. The fee for purchasing the copyright or produce movies didn't go into cost directly. Instead, it went to Netflix intangible asset. Then Netflix add them little by little into every year's cost through intangible asset depreciation. Like I mentioned before, depreciation is a type of non-cash expense. When to do it, how to do it, how much to depreciate are all very subjective. Earlier I said financial guys make their judgment, but who makes judgment for financial guys? Management. The official rules for depreciation. Depreciation is calculated using the straight line method over the shorter of the estimated useful lives of the respective assets, generally up to 30 years, or the lease term for leasehold improvements, if applicable. This is just a Netflix general guidance, not even close to any strict regulations. So how do you depreciate a movie? What's the difference between Shawshank Redemption and 50 Shades Darker? An IMDb score 9 movie and a score 4 movie. How different should they be treated when depreciating? I would depreciate 50 Shades Darker the first second. Who's going to watch that in 10 years? People may ask, the management can do whatever they want? Yeah, pretty much. Both the international financial reporting standards or the generally accepted accounting principles agree that company reserves the right of final explanation on intangible asset depreciation. So, with only one method, depreciation, they can manipulate the financial statement to achieve any net income they want. Of course, there are other tools in their tool chest. But I don't want to explain 24 hours and you don't want to learn the boring accounting knowledge. So I'll just give you one more example. Netflix was founded in 1997 in Scotts Valley, California. It was originally a rent-by-mail DVD service that used a pay-per-rental mode. It's 2020. How many people still watch DVD? Yes, I admit there are still DVDs around, but who still rent DVDs, especially by mailing? Nevertheless, this service still exists. Why do they still run this? Almost nobody is using and almost no income. One likely reason I can think of is they accumulated a lot of assets when majoring in renting DVD. If they stop doing this, these assets need to be written off. the net income will go down, giving an ugly financial report. Therefore, they still keep this part of service. Of course, if you are their fans and want to say they did this to help the community, be my guest. When reading Netflix financial statement, I would stop wasting time on net income, EPS, etc. The most important indicator I would look at is subscription number, especially the new subscribers numbers. This is something they cannot manipulate unless they want to be charged with fraud. With this number, you get an idea with the total income, relatively reliable. We talked a lot about how they manipulate the financial statement, but why? The reason they do so is for the stock price. If net income increases, the company's net profit will increase. Also, the company's value is calculated based on the net income. The more value the company has, the more money it can borrow. Despite all the manipulation we talked above, Netflix is still a great company. All those methods are within the law and regulation boundary we mentioned before. But with the way this company manipulates its financial statement, it is likely to be overvalued. If you're a value investor, watch out. I mentioned at the beginning that there are companies doing exactly the opposite, which is manipulating to obtain a low net income to make the company undervalued. The representative is Microsoft. If you would like to learn about Microsoft, you can click the like button or leave a comment. I will be happy to make a video next week about Microsoft's financial statement manipulation. Thank you. Goodbye.